Excuse me, good people, and bad. Look, it's your man Rob.Sergio.Mack with the Three Keys Podcast. And I got my partner out here, my player partner. He's one of my favorite lenders, Prentis Turange. How you doing, Prentis?
Man, I'm feeling good, man. Sunshine, I'm feeling good.
All right, how long you been in mortgage, man?
My man, this is going on my 24th year.
24 years, man.
Yeah.
You know a lot, man. You're a very, very knowledgeable person. What y'all got out there now?
We've got a variety. We've got everything that everyone else has got. Plus, we've got the portfolio products for those special need clients.
Okay.
So we're focused towards doing low to moderate income product loans for our first-time home buyers. And the great thing about this product, in addition to it being geared towards low to moderate income, median income buyers, is, for example, they don't have to specifically be even a first-time buyer.
Let me ask you this. Let's say somebody out there, they want to get prepared to buy a house within 90 days. Mm-hmm. What's something that they can do right now to make that feasible or closer to coming to fruition in 90 days?
That's a great question, Mac. 90 days, what they're going to have to be aggressive, first of all, okay? Because when you're repairing your credit, it's a meticulous process, okay? So the first thing I always tell people is the acronym CIA, okay? So CIA stands for Credit Income Assets. So if you keep that in the back of your head, that's where we're going to start at. We always start out with CIA when you come to see me. So C, when you come in, we got to see where your credit is at.
Right.
Okay? So the main thing is this. Most programs out here require you to have a 640 credit score. If you're trying to get the bond program through the state of Tennessee for THDA, that's a hard stop, 640. Okay? We all prefer you to have a 640, but like I said, on our compensating factors program, we'll go down to a 620. 640 is usually the bottom rank. Okay? So what I always tell clients to do, first when they're starting out, pull your credit report. Okay, you can pull it for free. It's not costing you anything.
Right.
Okay.
You can do that once a year, right?
Yeah. But I tell them something to do it a little differently. Go on creditkarma.com. It's a free service, credit monitoring, credit building, the whole 9 yards. And what I tell them to do is, instead of pulling one tri-merge credit report, which is all three bureaus, is to pull one at a time. Okay. So if you pull, you're allowed to pull one bank at a time. That way you pull it every quarter, every 4 months. So effectively, you're monitoring your credit the whole year, and you're just checking it every 4 months.
Gotcha, because you're doing it one at a time.
Correct.
Instead of doing it all at one time, then you done burn through it for the year.
And that works about better, because then people can actually be proactive in seeing if they missed a minor medical deduction or whatever, because that's the type of bills that sneak up on people. You go to the doctor, you think your insurance paid everything, and then you find out, well, hey, I missed $100 deductible. Okay. And now the facilities, they don't even come to the people. They just put it on the credit report as a charge-off.
Yeah.
Okay. So it's stuff like that. We tell them, go on there, go on Credit Karma, pull it for free, see what's showing up on the credit report. And then, but I also tell them, before you start randomly paying off old stuff, get with your lender, myself, or whoever you're comfortable with. Make sure that you're seeing that, A, this is a fresh deal that needs to be addressed, and not an old deal that's already aged and timed out. Okay? So I tell them to get with me, get with their lender first, because we don't randomly want them restarting collection clocks.
Yeah.
Okay?
So when does that clock expire?
This is the thing. It's a tricky clock. And a lot of our buyers, a lot of our realtors out there aren't familiar with it. And because of the fact that in the state of Tennessee, on a collection, you can be sued for 7 years.
Right.
Okay? Now, the thing about it, after 7 years, they can't sue you, but they're allowed in the state of Tennessee to alleviate this derogatory on your credit for an additional 3 years. Okay? The benefit for them is they got 3 more years to impact negatively your credit. So let's say in that 10-year window, Prentis or Mac or Patrick, we decide we want to go buy a house. Okay, I can't sue you because we passed the 7 years, but guess what? I could still hit your credit. Okay? So if you go into the bank And the bank, a lot of the programs now say, okay, if you owe more than $2,000, $3,000, this has got to be resolved before we close. In the store, it don't matter how old that charge off is.
Message.
So for that creditor, it works out to their benefit because, hey, they got a 3-year extra net for something like that to occur for them to recoup their money. Okay?
Yeah.
And so the other kicker is, I warn people, never get into payment programs with the collection companies. And the reason I tell them don't get into a collection program is, let's say, for example, your collection account has already surpassed that 7-year window. Okay? They can't sue you after that 7 years. But what the collection companies have gotten so, how can I say this, slick about now is that they'll come to you and say, okay, Mr. Customer, Mrs. Customer, okay, you know this $2,000 you owe us. We'll put you on a payment plan. You make the minimum payment. Okay? You can afford $50 a month.
Right.
Customer says, yeah, I can afford $50. So they make that $50. Now, once they send in their check with their address on it, and that check gets cashed, that collection company's now got 2 things on you. They know where you live, and they know where you bank.
Yeah. They got that information.
Yes.
Yeah.
So now they're saying, okay, now we know where they live, we know where they bank. You know what? We really don't want to do this payment plan. We want all our money. Okay? So now they coming at you talking about, hey, we want all our money. You owe us all our money. You said, because once you sent that check, you restarted the collection clock. Okay? And that's what people don't realize. Once you send them that check, they cash that check. You have now just went back to a 7-year restart on that clock. So now they have a fresh clock to sue you because you got into the payment plan. Okay? And most people don't know that.
Y'all hear that, good people? Don't y'all fall for the banana in the tailpipe. Don't y'all do it. Yeah. If it's been over 7 years, don't sign up for a payment plan.
No. What you want to do is negotiate a full settlement in lieu of.
And drop it off. Okay.
All right. And what I tell people, when you negotiate with these people, first thing you want to make sure of is that they put it in black and white on their letterhead. Email it, fax it to you, mail it to you, whatever you got to do. Okay. But you want it in their on their letterhead, stating, okay, if Prentis pays you $300, you're gonna accept that as payment in full in lieu of, and write off the other $700 or $17, whatever it is. But you never negotiate with them if you don't have the money.
Gotcha.
Okay. We don't want to go out there and antagonize them, poke the bear, as they say, and we don't have no money. Okay. So that's the big thing. I warn people, make sure when you reaching out to these people, you start out low. Okay, if I owe you $2,000, I ain't gonna come in and say, "Can I pay you $1,000?"
Right.
I'm gonna come in and say, "Can I pay you $300?" Okay, and you gotta be aware of the fact that this is a collection company. This is not the original creditor. The original creditor, Citibank, USSA, they all had to write that money off. We only, as a bank, Simmons Bank, B of A, whoever we are, we only have 1 year to collect. After that, we have to charge it off when we can't do anything, but we can sell that account to recoup a small portion of our loss to the collection third party, and they can chase you as long as they want to because they are a third party.
Message.
Gotcha.
Okay, so once we relinquish all our rights to them, we might sell that. For example, you owe us, let's say that client owes us $2,000. We've been chasing them for a year. At some point, we say, okay, the year's up, we got to write it off per the regulators. We sell it to XYZ Collection Company, we might sell it to them for 20 cents on the dollar. Okay? So that $2,000 you owe us, we might have sold it to them for $400. Okay? Now, they've got $400 at the table on the spin. But the point is, guess what? where they make their money is the juice, the spread between the 400 and the
2,000.
$2,000.
Yeah,
Exactly.
absolutely.
Okay, it's like when you go to Las Vegas, the house always wins.
Right.
So we know we're gonna get at least that they as the collection company know we're gonna get at least 400.
Right.
That's bare minimum. Okay, but we going for that gravy. All right. They going for that 2,000. Okay. Now, where it gets real messy is, let's say you playing ball and don't want to pay me. Okay, you ducking and you dodging, but somewhere along the line, like I said, you slipped up, got in the pay plan. You already done restarted the clock. Okay, so just because you ducking and dodging me now don't mean nothing to me. Right. Okay, because you restarted the clock when you sent me the $50 check. Okay, so now the clock's restarted. I don't have to chase you no more. Right. I know where you live. If the address is on your check, all I got to do is pay the sheriff department to come out and serve you. Okay? Now, once the sheriff department serves you, it's basically game, set, match. Okay? Because once you've been served, if you do not appear in court on that summons date, it is what? Called a vacated judgment. Right. Okay? So, for your listeners out there that don't know what a vacated judgment is,
speak on it.
That means you said I'm not coming to court and they can't get me if I don't come to court. Wrong. If you don't come to court, your name's on the docket. Everything about you, your social, they've got all of that now. Okay, so you don't show up. XYZ collection companies, they showing up. Right. They've got the paperwork saying we bought this from Simmons Bank, B of A, whoever we bought it from. And Mr. Smith decided not to show up, Your Honor. He decided to avoid coming to court for his responsibility. The judge is then going to turn around and say, okay, you're right. They knew the date, they knew the time, they knew the place. So now that $2,000 that you owe this company, now it's going to expand. Right.
You got court costs, legal fees.
And see, there you go. You're a man that's been in the game. Yeah. You know what they're looking for. Exactly. Yeah. So now you paying for that company's attorney costs at $200 an hour or whatever they got billed. You got to pay for their attorney. You got to pay for the court costs. So that means basically now you paying for the sheriff's department that came out and served you. Yeah. Plus you paying for the judge time. Right. Okay. So now you got all of that. Okay. So now all of that becomes due now. So, okay. So now, guess what? Judge now rules in their favor. So now you owe that $2,000 plus probably another $2,000 to $3,000 in court costs and attorney fees. So now your $2,000 is $4,000 plus. Right. Okay. But it don't stop there. It gets worse. In the state of Tennessee, do you know how much the state of Tennessee allows that collection company to charge you annually on that balance?
25%?
30%. 30%, bro. So in the state of Tennessee, they are allowed to charge you 30% on that balance annually. It's like a lottery win for them. Yeah. Okay? Because now I've got this judgment. The judgment does not expire. You owed me 4, but now I'm getting 30% juice on top of that 4. Okay? Okay? Now, on top of that, the judge is going to give me documentation where I can turn around and get on the list to have the sheriff department go out here and seize your bank account. Okay? Because you wrote me a check. I know you bank in that region. Yeah. So I had the sheriff department go over the regions and seize your bank account. Yeah. All right? You out here paying bills and writing checks, and your checks is bouncing. Right. The bank is not allowed to call you up to tell you, hey, the sheriff department just came here and wiped out your $8,000 you had in the bank.
The jig is up.
It's all wrapped. Yeah. You on fumes. You zero, nothing, zero, nada. It's gone. Right. And you out here trying to pay your rent, trying to pay your car note. Your checks is bouncing, and nobody calling you to tell you your money is gone.
Yeah. All right, on count of 3, you hold up to that camera right there. You hold up. Should a person buy a car first or the house first? Okay, you ready?
Let's do it.
1, 2, 3. House.
There
Why?
you go. Because the house is building equity and legacy for their family.
Okay.
That's why.
That's why. And I agree. I agree there. And another reason I agree is because when it comes to your debt to income ratio,
absolutely,
a car note,
killer.
A lot of people riding around in their house.
Killer.
A lot of people driving around in their house.
And you know what? It's a sad thing, but in our community, it's a big thing. Okay? In our community, that I run across that, it seems like every week.
Yeah.
All right. Especially since the pandemic, where the manufacturers and the dealers have got these people riding around with $800-900 car notes, $1,000. All right, and you hit the next piece, CIA.
Assets.
So you know you hit income, debt to income ratios.
Right.
Okay, because right behind credit comes debt to income.
Exactly.
Okay, and the piece that people fail to realize, the layman out here, is you're capped at 45% debt to income. All right, and for your listeners, that's 45% of your gross. Okay, so for example, just to give you a quick thing here, if you're making $4,000 a month, folks, you take that times 0.45, that means that's $1,800 that you can use towards mortgage. Okay, but the big thing here is that $1,800 amount that I gave you also has to go towards car payments, student loans, credit cards. Okay, so if you're capped at 45% and that's an $1,800 mortgage, okay, on an $1,800 mortgage, that's what, a little over $320,000. Okay, but you got an $800 car note.
Yeah, and knocks you out.
That $800 car note gets shaved off to $1,800, and just this quick, you done went from $325 down to $100. Because now you at $1,000.
Right.
And that $1,000, folks, has got to include your taxes, your insurance, your mortgage premium, everything.
Right.
Okay?
HOA if it's there.
HOA, anything. Exactly.
Right.
So you just that quick, that car, like you just said, is your home. Okay? Because you can't buy a home now until that car is paid off, sold, or whatever.
Right.
All right. And then assets, the last piece of the acronym, you got to be able to show that you got at least 2 to 3 months of reserves of whatever that mortgage payment is going to run you.
Right.
Why do you think banks require that, folks? They require it because if Alfred or whoever goes out there and breaks their leg and can't go to work, guess what? The banks want to know you got enough to pay for that mortgage until your leg heals up.
Exactly.
Okay?
Yeah.
So CIA is critical. We're working on credit, we're working on the income calculation, and then we're working on making sure they got the asset reserves.
Okay, good. So another thing about our culture, another thing about our community, I don't want to make it a culture, but one thing about our community is we will wear our wealth and we will drive our wealth before we will live in our wealth.
Exactly.
And that's one thing I would like to change, and I really want to cultivate a place where if I can help shed information on how to invest, I will. I'm not going to hold that information. I know Prentis ain't going to hold that information, but we have to stop spending money and start investing money. I'm not trying to shame anybody out there, but if you are toting, for the women out there, if you're toting a purse that costs $1,000 and you ain't got $1,000 in your savings, something ain't right. If, for my brothers out there, if you go to your shoe closet and you got
all the Air Jordans,
you got $5,000 worth of shoes and $500 in your savings account, something ain't right. We have to stop wearing our wealth, stop driving our wealth, and start living in our wealth. Because once you purchase a home, that's living in your wealth, and you can pass on that wealth. You can't pass on them shoes like that. You can't pass them purses down like that. These things don't accrue no kind of equity whatsoever, like a house. Now, I didn't do a card about this next question because I get this question a lot too.
I got you.
And I know it's a case-to-case type of thing, but let's just say 51% of the time, in your opinion, at least 51% of the time, is it best to purchase a house or invest in your business?
I have to say, still going my house.
I agree. Why is that?
Well, because of the fact that with your business, your business is like a black hole.
Mm-hmm.
It's steadily absorbing your money.
Yeah.
Okay? And the problem with that is, at the end of the day, most businesses, no offense out there,
Mm-hmm.
but most businesses, they fail.
Right.
Okay? Let's just be real. Most businesses fail or they have negative cash flow.
Mm-hmm.
Okay? So I will always tell you to get that house first.
Mm-hmm.
That house, no matter what you do, is going up in value.
Yeah.
Okay?
Okay.
Short of dropping a match.
Yeah. Okay.
But the business, I've seen many a business owner,
Mm-hmm.
especially during COVID.
Mm-hmm.
Okay? Perfect, unfortunate change of circumstances where it wiped out life savings.
Yes.
Okay.
Yes.
You people can't go to the restaurant no more. You spend all your money. I saw where couples that moved to Nashville to Tennessee and they was opening up all these restaurants, all these businesses, and then COVID hit them.
Yeah.
And you can't open the restaurant up. You just put out all your money from your bank account to open up this restaurant. You sunk your life savings in, and guess what? Now here you are underwater, and now because of the fact you tied all your money up in this business, now on top of that, you might lose your house.
Right.
All right?
Mm-hmm.
And so I warn people, you got to know exactly in that situation what comes first. You got to be able to go home and sleep at night.
Mm-hmm.
Okay? We can worry about the business later.
Right.
Okay? They can't come and repossess my house if I'm still making my mortgage payment.
Exactly.
All right? The business, guess what? We can restart a business.
Mm-hmm.
Okay? But if you lose that house, you're going to lose your credit. You're going to lose your equity. You're going to lose your legacy for your kids. You're losing a whole lot more than just the business. You
Right.
lose, and the thing people don't realize, hey, once you get a house repoed, foreclosed, the banks, oh man, they ain't touching you.
Mm-hmm.
Okay? That window is shut for years.
Yeah.
Okay?
Right.
All right? We don't want to talk to you. We don't want to see you until, guess what? Until we forget about it.
Yeah. And some of them don't forget.
Exactly.
Yeah, Wells Fargo, they don't forget.
Oh man, they got elephant brains, man. Them elephant memories.
Yeah.
Them elephants. They say an elephant can see you and realize that you traumatized it as a kid.
Right.
And then when they see you as an adult, it's trying to tear your car over.
Yeah.
The same thing with the banks.
Right.
They don't forget. They traumatized and they sitting up there. Well, we remember when you beat us out of all this money.
Right.
We'll never loan you money.
Exactly.
Okay.
Yeah, and I agree for 3 reasons. One reason for what you named. A second reason is because usually when people start a business, a lot of us are trying to reinvent the wheel, or we're trying to start this groundbreaking thing, or we're grabbing something to try to make it bigger and better. Buying a house, it ain't a lot of brain work to that once you get it. Equity is going to come. You don't have to be this real estate guru for the equity to come, right? So that's one reason I say go with the house instead of a business. And secondly, most businesses that you start aren't going to be low risk, low return. A house is low risk, low return. Most businesses are going to be mid to high risk, and you're thinking it's going to be mid to high return. But a lot of times that's just not that. I'm a habitual business owner. I start a business tomorrow. And once you have your house in place,
Then you can gamble.
You can gamble like that. But if you don't have the house, because for my good people out there, even if you have a great business idea and you start this business and this business is doing well for you, if you're renting, you're taking all of this money you're making from this business and you're dumping a large portion of it to your shelter, and you're paying off somebody else's mortgage. So this next is going to be a good one. Are you ready for this one, Prentis?
Let's do it. What's up?
Okay. You got one. You got house and you got marriage. You got house, and should you get a house first or should you get marriage first?
That's a hard one.
It's a hard one. Now, I know it's a case-to-case type of thing, but we're going with the majority, at least 51% of the time.
Correct.
Okay.
Correct.
On the count of 3. 1, 2, 2, 3. Why you say house?
Look here. Look here. I think that 51% is low. I think the 51% is low. I'm going to be real, bro. Look here. As a financial consultant, as far as helping people get their money in line to get a house, that's low.
Right.
All right? And I tell you why. Okay, all you single women out there or single brothers, whoever the case may be, remember this, my good people. If you buy that house before you get married, that is your equity asset that you brought into the wedding, into the marriage.
Absolutely.
Okay, so if that marriage don't work out, and you didn't naively put that person, I don't want to offend nobody. My bad.
I'm gonna cut that out.
My bad. I didn't mean to say that. I'm just joking. I'm joking. Okay. So I'm just saying, if you know when you if you own that asset before you got married legally, and you didn't add that person to the deed.
Right.
If unfortunately it don't work out, they can take everything at the house, but they can't take the house.
Yeah. I agree for the same reason. A second reason is if you truly love that person and you want to try to secure a great foundation for the marriage, why not make you both homeowners? Because if I can get an FHA loan, and with an FHA loan, what kind of down payment I'm looking at? 3.5%. But if we're married, we both can only have that one. But if I get a FHA loan before I get married, and my fiance gets a FHA loan before she gets married,
Correct.
Now we got 2 houses going into the marriage.
Brilliant.
And now we can refi and make one of them into a rental property, and we come into the marriage with I got this,
you got that,
you got that, whatever.
Now we got
it.
Message.
All right, P. I tell you, man, it's been a pleasure as usual.
Goes quick.
It goes quick, man. So one more time, let the good people know how they can get in touch with you.
You can call me direct. Area code 615-414-5549. Again, direct number 615-414-5549.
All right, good people. So before I leave, I want to thank Prentis Turange for stopping by again, and also for the takeaway: the house before the car, the house before the business, the house before the marriage. And with that said, I love y'all. Ain't nothing you can do about it. Peace.